Ladies and gentlemen, friends, what I'm about to tell you may seem bold, it may feel uncomfortable, but if you are here with an open mind, ready to see what others ignore, then pay attention, because I believe something big is coming for silver in March 2026. And by big, I don't mean a fleeting spike. I mean a convulsion rooted in forces far deeper than headlines. When you look at the world through the lens of markets and economics, it becomes immediately clear that nothing moves in a straight line. The financial world, the economy, even human behavior, all follow patterns that repeat over time. Yet, despite this, most people approach investing as if tomorrow is completely random, as if prices, markets, and economies are guided by chance rather than by discernible forces. That is a fundamental mistake. To succeed over the long term, you must first understand the macro forces at play, the cycles that govern the rise and fall of economies, the ebb and flow of markets, and the patterns that have repeated themselves throughout history. When we speak of cycles, we are talking about more than just short-term fluctuations or market noise. These are the big structural rhythms of the economy: the debt cycle, the currency cycle, productivity growth, inflation and deflation, and the interplay between central bank policies and private sector behavior. Each of these has its own tempo, and when they intersect, they create forces that can move markets dramatically. For example, when debt levels rise beyond sustainable levels, when central banks tighten or loosen policy, when currencies start to lose their credibility, these forces do not act in isolation. They interact, they compound, and when that happens, markets react, often sharply and suddenly. Most people, however, do not pay attention to these forces until it is too late. They look at yesterday's returns and assume tomorrow will be similar. They extrapolate short-term trends into the future, thinking they can predict the market. That is why so many investors are shocked when what they thought was stable suddenly becomes volatile. True understanding comes not from trying to predict exact outcomes, but from seeing the underlying structure, seeing what is driving people's incentives, government policies, and market behaviors, and then understanding how these forces interact over time. Take, for instance, the debt cycle. Debt can stimulate growth and increase purchasing power, but it is a double-edged sword. As debt grows, so too do obligations and vulnerabilities. Eventually, there comes a point where debt becomes unsustainable. At that tipping point, markets respond violently. Inflation may spike, currencies may weaken, and assets that were previously safe may decline in value. These cycles repeat across generations. They are not random. By observing them, by understanding their logic and patterns, you can position yourself to weather storms rather than be swept away by them. The key principle here is that cycles are real and recurring. The boom and bust cycles in commodities, equities, and bonds are not anomalies. They are the natural consequence of incentives, human behavior, and policy responses. By learning to read these patterns, one begins to anticipate conditions where risk and opportunity converge without ever claiming to know the exact timing or magnitude. This is what separates the disciplined observer from the gambler, someone who acts based on probabilities informed by patterns rather than hope or fear. Another critical aspect is to recognize that these macro forces operate at multiple layers simultaneously. There is the short-term market cycle, which can last months or a few years. Then there is the intermediate-term economic cycle, often spanning 5 to 10 years, influenced by credit availability, consumer confidence, and investment trends. Above that is the long-term debt cycle, spanning decades, shaped by generational shifts in borrowing, spending, and global imbalances. To truly understand the economy and markets, one must see how these layers interact. Often, it is the alignment of multiple cycles that generates extraordinary market moves, the kind that seems inexplicable to those who only look at one level of reality. Yet understanding cycles does not make you omniscient. It does not allow you to say with certainty that silver, gold, or any asset will rise or fall on a specific date. Instead, it gives you a framework to think about risk and opportunity. It allows you to ask the right questions. Where are we in the debt cycle? Where are interest rates headed? How is the central bank likely to respond? What is happening to global trade and currency values? By answering these questions honestly and systematically, you reduce uncertainty. You replace guesswork with a structured way of observing reality and positioning yourself accordingly. One of the most important lessons in observing macro forces is humility. Markets are complex. Human behavior is complex. No model is perfect, no prediction guaranteed, but cycles, by their very nature, provide a roadmap. They tell you that booms are temporary, that busts are inevitable, and that the market always moves in response to underlying forces, whether people recognize them or not. The disciplined investor does not fight these forces. They study them, anticipate them, and build systems to navigate them. Finally, understanding macro forces is not just about economics or finance. It is about recognizing how human nature, policy, and incentives interact. It is about seeing reality as it is, not as you hope it to be. When you view the world in terms of cycles, patterns, and structural forces, you develop a lens through which uncertainty becomes manageable. You do not predict the future, you prepare for it, and preparation based on reality rather than speculation is the true path to resilience and success in markets and in life. One of the most important principles in investing, one that separates long-term success from short-term disappointment, is the idea of diversification. Many people think of diversification simply as spreading their money across a few different stocks or sectors. That is only scratching the surface. True diversification is far deeper. It is about building a portfolio in which the components do not move in lockstep with each other, where the success of one asset does not automatically depend on the success of another. It is about recognizing that risks are interconnected and that the world is full of uncertainties that can strike when least expected. Most investors underestimate the importance of diversification because they think in terms of potential returns rather than potential risks. They look at a single investment, a stock, a bond, a commodity, and imagine the best case scenario. They assume that if they pick the right asset, it will deliver extraordinary gains. The problem is that this approach ignores the reality of markets. Markets are volatile, unpredictable, and influenced by factors far beyond any one investor's control. A single asset, no matter how promising it appears, is always exposed to systemic risks, market shocks, geopolitical events, and shifts in human behavior. When you put all your eggs in one basket, you are implicitly betting that none of these risks will materialize, a bet that history has repeatedly shown to be unwise. True diversification involves combining assets that respond differently to the same set of economic and market forces. In other words, you seek uncorrelated bets. These are assets that do not rise and fall together, so that when one underperforms, another may perform well. This principle applies not only to the traditional categories of stocks, bonds, and commodities, but also to less conventional assets, currencies, real estate, private equity, or even alternative investments. By understanding how different assets behave under different economic scenarios, you can construct a portfolio that reduces overall volatility without necessarily sacrificing long-term returns. Many investors fail to diversify properly because they focus only on nominal variety rather than true uncorrelation. Holding 10 stocks in the same sector or geographic region does not provide real diversification. If the sector or region faces a downturn, all 10 stocks may decline together, leaving the investor exposed. The same principle applies to bonds or commodities. Real diversification requires careful analysis of how assets are likely to behave in different economic environments, inflationary periods, deflationary shocks, rising interest rates, currency crises, and market panics. By combining assets that respond differently to these scenarios, an investor builds resilience into their portfolio. Another critical aspect of diversification is sizing. Diversification is not merely about owning different assets. It is about allocating your resources in proportion to risk. Some positions may have higher potential returns, but also higher potential losses. Others may be safer but contribute less to growth. The key is to balance these positions in a way that your portfolio as a whole is not overly exposed to any single outcome. The goal is not to eliminate risk. Risk is inherent to investing, but to manage it intelligently so that no single event can decimate your wealth or derail your long-term objectives. It is also important to recognize that diversification is dynamic, not static. The correlations between assets can change over time. Assets that were uncorrelated yesterday may become highly correlated during a financial crisis. safe haven assets may suddenly fall alongside risky ones if market panic spreads. This is why diversification requires ongoing observation, adjustment, and adaptation. It is not a one-time task, it is a continuous discipline. By constantly monitoring correlations, exposures, and economic conditions, an investor can ensure that their portfolio remains resilient under changing circumstances. Diversification also demands psychological discipline. Many investors are tempted to concentrate their holdings in a hot asset or market simply because everyone else is doing so or because recent performance is attractive. This is the behavior that leads to bubbles and subsequent crashes. By maintaining a diversified approach, you remove the need to chase short-term trends or speculate recklessly. Diversification allows you to stay calm, to think in probabilities, and to focus on long-term outcomes rather than the noise of the market. It is a framework that lets you act rationally when others are driven by emotion. The power of diversification becomes especially clear in extreme conditions. During periods of market stress, the benefits of uncorrelated assets are magnified. While some parts of the portfolio may decline, others can rise or remain stable, offsetting losses and providing liquidity or opportunities to act. Without diversification, a single adverse event can wipe out gains accumulated over years. With diversification, the portfolio can absorb shocks, survive crises, and continue compounding over the long term. This is why the most successful investors rarely experience catastrophic losses. They understand that no one can predict every outcome, but they can structure their portfolio to survive and thrive regardless of what happens. Ultimately, the lesson is simple but profound. Do not put all your eggs in one basket. True diversification requires understanding how different assets behave, maintaining balance, monitoring changing correlations, and resisting the temptation to chase trends or overcommit to a single position. It is not glamorous. It does not promise spectacular short-term returns, but over time, it produces resilience, stability, and the ability to take advantage of opportunities that others cannot. Diversification is not a strategy for luck. It is a strategy for reality, a recognition that uncertainty is inherent, that risks are interconnected, and that the wisest course is to manage them intelligently. The investor who internalizes this principle will approach markets with clarity, patience, and humility. They will construct portfolios that withstand shocks, capitalize on opportunities, and compound wealth steadily over time. They will understand that the world does not operate on certainty, but on probabilities. And by embracing uncorrelated bets and true diversification, they can navigate those probabilities with confidence and foresight. The most difficult thing for most people to do in life, in investing or in business, is to see reality clearly and then act on it regardless of what everyone else believes. Human nature inclines us to follow the crowd, to trust the majority opinion, and to seek comfort in consensus. But history shows again and again that consensus is usually wrong at critical turning points. Markets, economies, and human affairs are driven by forces that most people do not understand, do not want to confront, or are too afraid to question. To navigate complexity successfully, you must think independently, discard the comforting narratives of consensus, and confront reality with radical honesty. Thinking independently requires first recognizing that most people are biased. Their opinions are shaped by their experiences, emotions, social pressures, and the stories they have been told. They often rely on what has happened recently, projecting it into the future, or they adhere to conventional wisdom because it provides security. But the world is rarely that simple. What worked in the past rarely guarantees success in the future. True insight comes not from repeating the thoughts of others, but from analyzing the underlying mechanisms that drive outcomes and being willing to reach conclusions that feel uncomfortable or unpopular. Discarding consensus does not mean rejecting all advice or ignoring expertise. It means recognizing that the majority is often wrong, especially when there is a strong emotional component, groupthink, or incentives that distort reality. If everyone believes a market will rise tomorrow, it may already be priced in. If everyone believes an economic crisis cannot happen, that belief may create the very fragility that makes it inevitable. By stepping back, questioning assumptions, and examining the incentives and forces at play, you begin to see possibilities that the crowd cannot add. Independent thinking is not rebellion for its own sake. It is the disciplined observation of reality without distortion from social pressure, or self-deception. To think independently, you must also embrace radical honesty. Honesty not just with others, but with yourself. Most people avoid uncomfortable truths because they are inconvenient, threatening to their self-image, or emotionally painful. But reality does not bend to our wishes or fears. Ignoring problems, exaggerating your abilities, or rationalizing mistakes does not make them disappear. It magnifies them. By facing reality as it is, accepting both your strengths and weaknesses, understanding the forces beyond your control, and being brutally truthful about risks and opportunities, you equip yourself to act decisively and effectively. Radical honesty also requires humility. You must acknowledge that you do not know everything and that your assumptions are likely to be incomplete or biased. Yet acknowledging this uncertainty is empowering rather than paralyzing. It allows you to explore multiple perspectives, test your ideas against reality, and seek feedback from people who challenge your thinking rather than reinforce it. The combination of independent thought and radical honesty creates a powerful feedback loop. By constantly confronting reality, questioning consensus, and adjusting your beliefs, you gradually refine your understanding of the world and your ability to navigate it. Most failures occur because people cling to consensus and ignore signals that reality is shifting. They follow the crowd in rising markets, and when the downturn comes, they are unprepared. They adopt popular narratives about the economy, investments, or politics, and when those narratives break down, they suffer losses that could have been avoided. Independent thinking is the antidote. It allows you to see early warning signs, anticipate changes before they are obvious to everyone else, and position yourself in a way that protects against catastrophic risk while taking advantage of opportunities. Independent thinking is not a solo exercise. It is a disciplined process. It requires gathering information broadly, analyzing it rigorously, and separating signal from noise. It requires questioning assumptions, testing hypotheses, and being willing to change your mind when the evidence demands it. It also requires courage. Acting on an insight that contradicts consensus is uncomfortable. It may attract criticism, skepticism, or even hostility, but the alternative, following the crowd blindly, almost guarantees mediocre results at best and disastrous outcomes at worst. One of the most powerful aspects of independent thinking is that it forces you to confront the harsh realities that most people ignore. Economic cycles, financial imbalances, political instability, technological disruption, these are not mysteries to be solved by wishful thinking. They are forces that will act according to their own rules, whether you understand them or not. By seeing them clearly, without distortion from conventional wisdom, and by accepting your own role and limitations honestly, you position yourself to benefit from shifts that others fail to anticipate. Independent thinking and radical honesty are mutually reinforcing. The more you commit to seeing reality as it is, the less you are swayed by consensus. The less you follow consensus blindly, the more you develop the discipline to confront difficult truths. Together, these principles allow you to navigate complexity with clarity, avoid unnecessary risk, and exploit opportunities that are invisible to those who are bound by social conformity. They create a mindset that is grounded in reality rather than illusion, in understanding rather than opinion, and in action rather than wishful thinking. Ultimately, the lesson is simple. The crowd is often wrong. Reality is relentless, and your success depends on how well you see both. Independent thinking allows you to question, analyze, and anticipate. Radical honesty allows you to see clearly and act decisively. Together, they form the foundation for making sound decisions in an unpredictable world. Those who master this approach are not merely surviving uncertainty. They are thriving in it, turning complexity and change into opportunity, while the majority remain trapped in consensus, blind to the realities shaping their future. We are not gamblers. We are not fortune tellers. We are builders of a system of thinking that respects the laws of economics, history, and human nature. If you listen carefully and if you stay humble yet alert, silver's potential surge in March 2026 could be more than a market event. It could be a wake-up call, a reminder that true opportunity lies not in following the crowd, but in understanding reality before it becomes obvious to everyone. Because, as I often say, the most valuable thing you can do is understand reality and deal with it. So prepare. Diversify, observe, And when the time comes, act not out of fear, but out of clarity. Thank you.